Welcome back, my friends. Well, big oil is back in a big way. Chevron just announced a $75 billion stock buyback. And a big dividend boost on top of that. Just when you thought the era of fossil fuels was over. And the future was going to be ruled by Elon Musk and Tesla. Well, not so fast, my friends. The buyback program will become effective on April 1st. The stock buyback has no set expiration date. The dividend hike is just icing on the cake for shareholders. The dividend boost increases Chevron's per share payout to $1.51 per share from $1.42. The higher dividend will be payable on March 10th. Chevron's market cap was $350 billion as of Wednesday's market close. That means that the stock buyback would represent more than 20% of the company's stock at current prices. Of course, that assumes that they won't give more of it out to executives. But, regardless of how big oil majors seem to be rolling in cash now, it seems to make sense that they eventually buy back their shares. That way, there are fewer outstanding shares to spread the dividend around. If you were watching the stock market, you know that energy stocks are the best performers on the stock market this year. What does this mean for consumers? What does this mean for energy markets? What does this mean for oil companies? What does it mean for the US economy? And what does it mean for the future of the United States? But, before we get into all of that, please hit the like button and leave us a comment below. We would love to hear from you. Please subscribe and hit the bell icon so that you are notified of upcoming videos when they are released. Energy giant Chevron announced a $75 billion stock buyback program. And, of course, a healthy dividend hike. Chevron shares jumped by more than 2% in extended trading after the announcement. The buyback program will become effective on April 1st. The dividend hike increases Chevron's per share payout to $1.51 from $1.42. This buyback plan follows a $25 billion plan enacted in 2019. The old plan will be terminated at the end of March. Chevron repurchased $3.75 billion of shares in its most recent quarter. The new buyback plan comes after a blockbuster year for oil company stocks. The U.S. economy reopened as the pandemic came to an end. Russia's invasion of Ukraine drove oil and gas prices higher worldwide in 2022. Chevron reported more than $12 billion of free cash flow and $11 billion of net income in Q3 alone. Shares of Chevron rocketed by more than 50% in 2022. And that was in a year when the overall stock market declined. And all of this comes at a time of uncertainty for fossil fuel companies. Big oil majors like ExxonMobil and Chevron are making big investments. ExxonMobil, for example, is making major offshore investments in Guyana. But, frackers are being slow to get their rig counts back out into the oil patch. In fact, the White House's top energy advisor Amos Hochstein called shale drillers un-American. That is because of their refusal to boost oil production. Even though the White House has made multiple calls to that effect. Now, the frackers are striking back. Pioneer Natural Resources CEO Scott Sheffield is one of the most outspoken industry executives. Sheffield told the White House that shale drillers will not be drilling more and that is it. And he had an excellent reason for it. Sheffield said that returning to production growth now would cause investors to flee. Then, energy stocks will plummet to the bottom of the stock market. No public oil driller would increase production right now. U.S. frackers produce a 2% return on capital. That is the bottom of the S&P 500, Sheffield said. If we increase production, we'll end up back at the bottom of the S&P 500, Sheffield continued. Frackers are under intense pressure from investors. So, the U.S. shale oil industry will not start ramping up output until prices go up. 10 years ago, frackers always increased production when prices rose by even a little bit. But oil investors have been burned in recent years. They are watching how shale drillers burn their cash. Frackers turned the United States in the biggest oil producer in the world. Then oil prices famously crashed and went negative in 2020. Oil prices dropped below zero for the first time in history. Even though the drop was short-lived, it changed things for a long time. Now, 2 years later, it seems like a whole new world. Oil prices and shale drillers are different versions of themselves. No company is pushing the envelope to see just how much oil it can produce. Instead, shale drillers are teaching themselves capital discipline. Frackers are prioritizing their shareholders after, some might say, years of neglect. If you are watching the stock market, you know that energy stocks are the best performers on the stock market this year. And none of them want to rock the boat. They are not eager to respond to the calls of an administration. Frackers see the Biden administration as being against the whole oil industry. There are other barriers to increasing production. Oilfield services cost a lot more than they did a couple of years ago. And there are equipment shortages. Actually, the frackers are criticizing the oil majors for not growing more. Frackers need to pay 40% more for services to get 5% more production. It will also take a year to build new equipment. And it will take 2 years to start showing financial results. By that time, you may go through an oil price collapse, Sheffield explained. The White House messaging to the oil industry has had a remarkably short horizon, Sheffield added. The White House seems to be mainly focused on the immediate present market. The administration thinks that the industry could add another 1 million barrels daily to output in a matter of days, Sheffield also said. What they don't realize is that this is physically impossible, Sheffield also noted. Threats of windfall profits taxes have not helped put drillers in a more generous mood. We are eager to work with you, said U.S. Energy Secretary Jennifer Granholm. Granholm acknowledged that oil and gas were going to be used for a long time. But we all know that there is going to be an energy transition. If the transition happens too fast, it could have unintended consequences that hurt people, cause backlash, Sheffield added. Right now, the kissy-face messaging from the White House is unlikely to change shale drillers' minds. There is simply no good reason for them to drill more, and the administration cannot give them one. The oil industry is blamed for high gasoline prices. Oil firm executives are blaming Biden administration's policies. Anti-oil rhetoric, inflation, contractor time delays, and regulatory uncertainty. These factors are all negatively impacting drilling and production planning. Raging inflation and critical supply chain delays scuttled that growth. Growth was also muted due to the headwinds created by oilfield services limitations. Drillers were also scared by the risk of recession. The current state of affairs of the U.S. oil industry stand in stark contrast most of the past decade. Between 2009 and 2019, U.S. oil producers ran wild. They captured almost all of the incremental global consumption. OPEC Plus announced a production cut of 2 million barrels per day, starting in November. That is the equivalent to 2% of the global crude oil supply. Crude oil prices have risen sharply following the Russian invasion of Ukraine. But that was back in February. Russia has been a major global exporter of oil and gas. The United States is teetering on the brink of recession. The United States produces almost 19 million barrels of oil every day. But the United States is also the largest consumer of oil in the world. So, there is only so much crude oil available for export. And, until 2016, oil exports of crude oil from the United States were illegal. Saudi Arabia produces 10.8 million barrels of crude oil per day, which is just over half of what the U.S. produces. But Saudi Arabia uses only about 3.2 million barrels per day. They export the rest. Saudi Arabia is basically the de facto OPEC Plus leader and major exporter. The United States has huge crude oil reserves. But oil production cannot be boosted overnight. OPEC Plus is saying that their production cut is in response to a weaker global economy. President Joe Biden was disappointed by the short-sighted decision, the White House said in a prepared statement. The OPEC Plus decision was unhelpful and unwise, said U.S. Treasury Secretary Janet Yellen. Yellen spoke ahead of the International Monetary Fund and World Bank meetings in Washington, D.C. this week. For those of you not familiar with OPEC Plus, it is a group of some of the world's largest and most powerful oil-producing countries. OPEC Plus includes Saudi Arabia, Russia, Iran, Iraq, Algeria, Nigeria, and other oil-producing nations. It does not include the United States or Canada, two of the world's largest oil-producing countries. Saudi Arabia is seen as the informal leader of OPEC Plus. But large production cuts are uncharacteristic of the group. And, historically, production cuts have been difficult for the group to enforce. Crude oil prices peaked in June at more than $120 per barrel. But, fears of the prospect of a global economic recession have put oil prices on a persistent downward trend since then. And, high oil prices typically bring about demand destruction as people drive less when gasoline prices are higher. The production cut of 2 million barrels per day is intended to reverse this decline in oil prices. But, what do you think? Please hit the like button and leave us a comment below. We would love to hear from you. Please subscribe and hit the bell icon so that you are notified of upcoming videos when they are released. Please share this video on social media. Thank you for watching.